Hi everyone, welcome to today's webinar on financial strategy. This is our new InvestHorizon webinar for this month. I'm here today with John Brennan, CEO of Westpeak. I'm Perrine, I'm project manager at EBN, the European Business and Innovation Centers Network. EBN is a partner of InvestHorizon, an EU project financed by the European Commission and Eureka. InvestHorizon started last year, mid-2019, with the aim of recruiting up to 500 SMEs until the end of 2021. We are an accelerator program. The platform is always open for applications, so know that we have cut-offs, selection dates every 3 to 6 months. So if you have companies interested to apply, we have the next cut-off date at the end of July this year. Companies participating to the accelerator spend 4 to 6 months in the program. The main eligibility criteria to join this accelerator program are being in a deep tech sector of activity and seeking a Series A funding set at 2.5 million. The companies joining the program must also show that they already secured a seed funding and be located in an EU country or Eureka country. Once companies join the program, they are joining a coaching group for 2 to 3 months, an online coaching group with industry and finance experts who are there to help them fine-tune their business and investment strategy, with the aim of participating then to investment meetings on-site and online. Here is a screenshot of our website, so you can see all application criteria and details on the website, and have a link to the application form. So just a few words about the program itself. InvestHorizon, we have a community which is hosted by Euroequity, so I encourage you to join if you are not a member yet. We have more than 1,000 members already, and we have a lot of resources available for free once you are a member of the community. We have online classes on market and investment topics. We have webinars like this one delivered every month. The next one is already announced on due diligence on the 18th of June, and we will have another one on pitching on the 2nd of July. So now straight to our topic of today, financial strategy. Our expert today is John Brennan, is the CEO of Westpeak, which is a business and innovation center in the west and north region of Ireland. Westpeak is a very active member of EBN, and John has a long-term experience working with startups and scale-up. He prepared a very good and thorough presentation for you to understand better how to build up your financial model and attract investors. So I'm very happy to have him as a speaker today. John will have 20 to 30 minutes to present, and then we will go through your questions in the Q&A part. So you can already start asking your questions during the presentation in the questions window, or you wait until the end of the presentation at 4:30 to start. I just want to ask you to be concise and clear when writing your questions, so we have enough time to go through all the questions. So that's it for me. John, you have the floor now. I'm going to stop sharing my screen.
Okay, so
You can start
Thank you,
sharing
Pauline.
yours. Yeah.
I'm just trying to do that now.
Yes, it should be
Okay.
good. Wait, share your screen again. Yes, going to disappear. I wish you all a good session.
Okay. So I need to move my own screen, my own face out of the way. So good afternoon, everybody. I hope you can hear me, and thanks for joining the financial storytelling webinar this afternoon. It's a lovely day here in Ireland, so I hope it's also nice where you are. So just going through the presentations, starting maybe with a bit of background. So my screen isn't moving, Perrine.
Okay. We see your first slide. Do you want us to take
we
over?
have it.
I know
Yeah.
it's good. We see
No,
you.
it's
Yeah.
okay. Yeah.
Okay. Fine.
The joys of working with technology. Okay, I think we're okay now. So listen, thanks again for joining the webinar. A bit of background details on how we work here in Westpic. So when we're working with founders, it's always on a one-to-one basis. So we're working with the founders, trying to understand the business, trying to understand where the business is at and where they want to bring it to. And most founders come from a technical background, and they usually have little or no financial experience. The last time they had some experience with finance might be when they last looked at their bank statement, or it might be going back to their school days when they were working maybe with accounts. But usually by the time they arrive at our door, their financial background and experience is well behind them. But when you're starting a business and when you're a startup, you need to understand how the business works from a financial perspective. And you need to be able to explain that to potential investors and other funders. Some of the key things that you need, if you're looking at, trying to develop a financial model, the first thing that you need is a solid financial model, which you can update and adjust regularly, because as you go through the business development process, typically you will access, new information on a regular basis, whether it be about the market, your pricing, the costs, the number of people you might need in your team, etc. And as you acquire this information, you need to be able to update your model on a regular basis to adjust for any changes. The other key point we feel is that you need to be able to take ownership of your model. It's not really beneficial to you as a startup if you hand over the workings of your model to a finance house, an accountancy practice, and ask them to do the work for you, because you're not really learning, you're not really understanding how the business works from a financial perspective. And therefore, we really feel it's important that you do try to understand the financial aspects, but also take ownership of the model. You need to figure out how much money you need, which is the investment side, and where that's going to come from and how long it's going to take. And as I said, you need to be able to flex the model to be able to review different scenarios from optimistic to pessimistic, best case to worst case. And in doing this, you eventually arrive at maybe the optimum business strategy for your business. So financial model, I just don't want to spend too much time on this, but I want to give people maybe an overview of what a financial model looks like. And models differ, they come in all shapes and sizes, from the approach that we might take here in Westpic versus the approach that somebody else might take. And that's all fine. There isn't, I think, a consistent approach to preparing a financial model. And what I'd like to take you through is the approach that we take with startups, which has evolved over a number of years. And Perrine will be able to distribute the Excel model, which is what we've based this webinar on, following the actual presentation. And you can work through it. It's based on a particular sort of setup, which you can see here is based on both a product and also a SaaS component. So the idea here is that where do you start? So we ideally want the business to start with some of the key variables. So the first one we asked them to look at, well, firstly, is what's your start date. So we try and give them a flexible model that they can take ownership of, and they don't have to worry too much about how the profit and loss account and the balance sheet and the cash flows are all calculated. But they can focus on the key elements, the key variables, which in this first slide is the price. So we start with the start date, in this case, the 20th of July, and then we ask them to put in the pricing variables. And for this model, again, we have product 1 and product 2, which can be renamed to whatever are the right names for your particular product. And we also have in this business a SaaS product. So that's basically maybe a cloud, it's a digital business. So it might be a cloud-based service. And again, you're putting in the price for year 1. You can increase the price in years 2, 3, 4, depending on what your requirements are. Often difficult to change the pricing for in a startup scenario. After that, we ask you to look at, typically what sort of sales do you expect to generate? Again, for the product and also the subscriptions for your SaaS model. And this information really comes from the research that you're doing on your business. And as I said earlier, these figures will often change from 1 month to the next, and maybe even from 1 week to the next. The combination of the pricing and the sales units allows us then to generate the sales revenue, which you can see for quarter 1 here is between the two products is nearly 69,000, and then the SaaS revenues are much lower at 3,000. And this is just an extract from the model. So this is extrapolated out over a number of years. Our model goes out to 5 years. Typically, most models, I think most investors will look for a 3-year model, but we often like to see how it pans out over a 5-year period. And I'll explain why that is the case in the coming slides. The other variables that you need to add then to the model would be your direct costs. So there might be a manufacturing cost for products 1 and 2. There might be commission on sales, and there may also be shipping costs. And these are input into the model. And a lot of these, the model is formula driven. So it calculates, once you put in the product 1 at cost, etc., it calculates the total cost for the quarter and so on. The other key area that you need to address, and this is usually a big cost area for most startups, is the HR recruitment plan and the salaries that you're going to incur. And we like to map these out on a monthly basis because typically they're a big component of the overall financial model. And what you might notice here is that the CEO is in 2020 being paid 45,000 and the CTO is being paid 70,000. And actually, that wouldn't be that unusual for a startup, whereby the founders might, in the initial years, pay themselves a lot less compared to some of the other key hires that they need to make. But the key point here is that we need to be able to plan out over 4 or 5 years what the recruitment plan is going to be. And the most critical part of this would be the first 2 to 3 years. Who do we need on the team? And in what order do we need to recruit all of these people? That in turn leads us then to the general overheads. Again, we try and create a simple format whereby you can add your general overheads, whether they be R&D for the likes of product development, software development, marketing, promotion, hosting. And this again is just an extract from the overall sheet. So there are a number of other categories which then feed into the overall profit and loss account. Once you input all of this data, and you're really just concentrating on 3-4 sheets here to input the data, and we try and make it as easy as possible for the startups to input the key variables. The formulas then generate the profit and loss account, they'll generate a cash flow statement, and they'll also generate a balance sheet. And I don't want to go into too much detail on the specifics of all of these sheets, but I do want to show you maybe some of the things that will emerge typically from the model. And this is just a summary of the figures that we generated from this particular model for the company XYZ Co Limited. And what you see here is that in year 1, they're generating sales of 300,000. And it goes up to, over a 3-year period, it goes up to nearly 1.9 million. In that period, there are losses of nearly 600,000 to begin with. And as the company scales and as sales increase, the losses go down. They start at nearly 600, they go up to nearly 800. And then as the company's beginning to scale and as costs begin to stabilize, they go down to -267. And in our example here, the investment was 600,000, and this was based on the, I suppose, the startup's initial expectation that, well, what do we need to fund the business and to keep it going over the first couple of years. However, when you look at the closing balance on the cash flow, you see that it's actually at the end of the year, it's a minus nearly 23, and then it goes up to a minus 84. And that's really a problem. And this is one of the key things that the model allows you to determine is, what level of funds do I need to start this business in the context of the expected increases in sales and in the context of the expected expenditure that we might have on things like both the direct costs and then our overheads, and our key overheads might be things like salaries and our business development costs. And taking all of that into account and then injecting 600K of investment in the business, in this case, we end up with a minus 22, and then it grows to a minus 831. Now, that's just not going to wash in the context of a startup business. The one thing you need in a startup is you need plenty of cash. You can never get to a situation where you're in negative figures. You always need to have positive cash in terms of your closing balance. And when you look at your bank statement, it can never be in the red, because the one thing that you need is cash to develop your business. So if we're presented with this situation as a startup and we have 600,000 of investment and we have these negatives down here, we need to rectify this situation. So what are our options? Well, one is to increase the investment. The other is to increase sales, but that's often difficult to do as a startup. And when you're starting out, it's always difficult to estimate what the sales are going to be at any rate. And usually investors, when they look at your sales figures, they will often discount them. So that's not an easy an easy option in terms of rectifying this solution. The other options would be to reduce your costs. And that might mean slowing the staff recruitment plan. It might mean reducing the R&D investment, or it might mean reducing your business development expenditure. All of these will have an impact on the growth of the business. So they're not typically what you want to do. So let's say in this case, we decided we were going to inject, we had investors that liked our business proposal, and we were going to speculate that maybe we could secure another 1.5 million in the year ending June 2021. So that certainly solves our problem. Our closing balance there is nearly 1.5 million at the end of year one, and it's nearly 670,000 by the end of year two. So it looks like we've plenty of cash cover, which is exactly what you need. However, the question that might be asked by your investors when you're asking them to stump up another 1.5 million is, well, if you're only going to get to maybe 8 million in sales by the end of 2025, is it worth that a level of investment? Can we generate a return on 2.1 million of an investment in this business if it's going to generate maybe just 8 million in turnover over a 5-year period? Now, 8 million in turnover is not to be scoffed at, but it's in the context of the investment that you're looking for. Is that investment, is that return, that scaling and that increase in sales going to justify that level of investment is what we're asking here. Some of the considerations that investors might look at here is, well, the operating profit is pretty good. You're getting 3 million of an operating profit from nearly 8 million in sales, so that's pretty good. The other thing they might say is that this business seems to be doubling its sales almost annually. So these are the kind of factors that I think investors will look at in terms of whether this is considered a good bet and a good risk for them or not. And what I'm really saying here is these are the issues and the scenario testing that you as a startup and you as a business person need to evaluate. And a lot of this is where you need a flexible model that you can say, let's look at the option of going 600,000. If that's not going to work, let's look at the option of going with, the 2 million and see how that works. And all of these considerations may be part of your discussions with investors to see how they fly and how they may not fly. So some of the considerations, not dwelling too much on the model per se, but some of the considerations that I think you need to take account of is, what revenues are projected, what level of revenues can you project each year over a 3 to 5 year period, and how can the business be scaled? What are the direct costs if these apply, and if there's, for example, the manufacture of a product associated with your business, which is the case here. The team is usually a big cost. How are we going to, how is the team going to be recruited, and how is that going to develop, and how many people in each skilled area do we need? How much money do we need to spend on R&D? And then what's crucially important is the business development side, because this is all about securing the sales and bringing the customers on board and developing your customer base. For startups, the general overheads are usually low, and they're usually not a key cost area. So that's one that you wouldn't typically expect to see a lot of expenditure in for the first couple of years. CapEx, if there's any specific requirements for equipment, etc., you need to feed that into the model as well. And then key to the model is how much investment is required and when do we need that. Usually it's as quickly as possible. And, a key part of it is how much is accessible realistically. Sometimes, like for example, in this business, ideally you might need 2.1 million, but realistically you might only be able to get access 600K. So that's where you need to go back and look at the business strategy and look at the financial strategy and see how can we actually develop and scale this business, maybe on a reduced level of revenue. So that's a really important aspect to look at. And ultimately, in testing and working through a number of different scenarios, you can assess which is the optimum, which is the best business strategy for your particular business. So that's essentially about the model, and trying to develop a model that you can flex and go, work through a number of different scenarios as easily as possible and as frequently as required. Once you've completed that process, you're then into the next stage, which is really where you need to be able to tell the story about, how your business scales, how the business develops, and how it makes sense from a financial perspective. And, part of this can be told in slides like this, and often it's a case of you might be making a presentation to an investor, you might be having a discussion with an investor, and you need to be able to maybe give them in simple sort of bite-sized chunks the breakdown of how the business will scale. So it might be something like this. It might be that the first phase is about building the capability of the business, which essentially means, building the team, completing the product development phase, and then securing the target customers for phase one of the business. The next part of it might be the development of the market in terms of adding to the team, expanding the market, securing the phase two sales targets, which then leads you maybe to moving on to a phase where you're going to stabilize and grow the business. And that's typically where you've secured enough sales in the business. The team is getting to a level where you've got all the key hires in place, you've got all the key skills in place, and you're beginning to stabilize some of the costs, and you're now in a position where you can actually grow the business. And that then moves you on to the next phase, which we would call maybe scale at pace. And that's where maybe you're escalating the marketing plan, you're bringing in additional salespeople, you're also looking at maybe new territories, new geographical markets, and you're trying to expand at a much faster pace. Typically, your investors and the people you need to tell the story to will also want to understand, well, okay, that's very good over a 3 to 5 year period, but what's going to happen, and what are the key focus points and key milestones for the next 12 months? And you might be starting here and you're saying, okay, we're going to secure 600K of investment, and that that's maybe the starting point here. And by the time you get that all in, it takes maybe the first month, which would be the month of July, and maybe a bit into August. And then from there, you're building the team, you're beginning to roll out the sales plan. And there are key initiatives that are going on here. And during maybe after the first 6 months, there might be a technical review, etc. And you're trying to map out exactly how you see the first 12 months panning out and what key milestones and targets you want to achieve. And that kind of focused approach really works well, I feel, with investors. And what you're doing there is you're linking that story back to how the finances work, because all of these have financial implications, whether it be securing the first 600,000 of investment, or whether it be bringing the team on board. Obviously, you need money to do that. Developing the market, you need money to do that. So it's like linking the key story within the business plan to the financial story. You can also tell the story by using, graphs and charts, etc. And often it's useful to be able to use these type of graphs and charts just to simply get across the message and some of the key sort of financial data that you might want to give to potential investors, etc. You're highlighting initially you're going to, you'll be in a loss-making situation, but over a 4-year period, you could see that the operating profits grow significantly. You want to show maybe the growth in the team, and you want to show maybe, how long it takes for you to get paid from your customers versus how long it's what credit terms you're going to get in terms of your suppliers. The other thing here is this is often an interesting graph to present, and certainly you wouldn't actually present this graph and I'll explain why in a minute. But often we would say to startups, okay, at the end of the month, how many times your actual expenditure have you got in the bank as your closing balance? So let's say at the end of the month, you're spending 50,000. You're 50,000 at the end of quarter 3. You're on a monthly spend, a cash burn of 50,000. Well, and what this is saying here is you've almost got 150,000 in the bank. So how many times your actual monthly cash burn have you got in the bank? And with this business here, because we were basing it on the 600,000 investment, you can see over time it goes down, way down. So we certainly don't want to show this picture to investors, but this is something that we have to rectify ourselves in terms of our story and presenting that story to investors. We can also use simple graphs to show how the sales grow per product. And like sometimes these charts throw up interesting observations that an investor might pick up on. For example, here we have product 1, product 2, and we have the subscriptions. And both product 1 and product 2 are growing at quite a substantial pace, but the subscriptions are barely moving from the 0 position. So I think the investors would ask questions here. Is your subscriptions mainly an afterthought, or is this something maybe we could drive a bit more, add additional investment and maybe increase sales here, or what's the position? So these are the kind of things I think you need to be prepared for. And sometimes in graphing these kind of things out, that becomes obvious. You can also present your cash flow, and you can show the cash profile in terms of the expenditure in each particular area. And then you can break down expenditure, and you can show also the profit and loss account in a graphical format. Ultimately, I think it's important that you're able to tell that story, whether it's using graphs or whether it's just on a one-to-one basis with a particular investor. You need to understand how your business is going to grow and scale in a profitable manner. You need to understand the relationship between the revenues, the costs, and the investment required. And as I said, you need to get comfortable telling that story, whether it's with your slide deck or without a slide deck. And the final thing I would say as part of the presentation is I think your financial model is constantly changing based on new market information and maybe feedback from your investors in terms of what their tolerance is for investment and what they would be willing to invest into the business. So you need to be able to take ownership. You need to be able to modify and adjust the model as often as needs be. So that's it from me from the perspective of the presentation, and I'm happy to take any questions that you may wish to pose with Perrine and through the system.
Thanks a lot, John. Maybe to start, where would you say is the best place to start when preparing a financial model?
Yeah, well, I suppose where it all starts is it's usually startups will, but by the time they get to the financial model, they'll have completed a lot of the market research, the feasibility testing, and therefore we often suggest that they start with the sales and the pricing, and that's often the first thing we will work with a startup on is trying to get the revenue model right, trying to get the pricing right in the context of the market, and also then trying to estimate what the likely sales will be from one year to the next. Very difficult to get these figures right, but you have to start somewhere. And really what you're doing is you're working off your best estimate, your best guesstimate, and you're using maybe your research into the market, into the competition, and you're using the feedback that you've gotten from maybe some of your key potential customers as a guide.
I'm going through the questions. Also, as a reminder for the attendees, please try to be short in the questions.
Okay.
Provided negative results, I was talking to the attendees, not to you, because it's provided negative results in year 1 to 3. How do you value a business based on the future cash flow?
Yeah, it's the negative results in years 1 to 3 are really common, and anybody that tells you that won't happen is not being realistic, because usually what's happening in that particular situation is, when we look at how the investment, startup investment money secured, how that is actually spent in the business, a huge percentage goes on building the team. The next biggest percentage usually goes on the business development costs. There may be some aspect of it goes towards working capital is always important, but in a lot of it goes towards building the team, put in place the resources and the capability that you need. And to do that, the costs come first and the sales and the revenues generally follow. So there's a lead time there between you in building the team, building the capability, and then converting all of that into revenue. So investors understand that. And most, say for example, we work quite a bit with business angels, and most business angels, will have gone through this process themselves, and they will understand that you're not going to generate profits in the first couple of years, but what you need to keep the business going is sufficient cash. In terms of the valuation, it's a bit of a black art, really. I don't think they look at the bottom line from the point of view of the profit and loss account in the first year or two. I think they look at the potential of the business over a 3 to 5 year period. They want to understand what the market size is. They want to understand if you've got the capability to implement your business plan and what's required. And they are particularly interested in the capability of the team to make this happen. So I think they discount the finances hugely, and I think they look at the bigger picture in terms of where this business can go in terms of putting a valuation on it.
Thank you, John. You mentioned, I'm going through the questions. So you mentioned a few ratios and figures, like the ratio revenue to operating profit, increase in sales per year. Can you give some more examples for figures and ratios into which investors are most interested in? Yeah,
I don't think investors get bogged down with ratios in the main. Maybe especially not at the seed stage. When you get to the when you get to the scale-up phase, they will maybe be a bit more concerned. I think one of the things in our example, for the example there, we had a product which obviously had a manufacturing cost. So one of the things they will certainly look at is the gross margin. And our gross margin was around 70%, if I remember correctly. So that's pretty solid. That's pretty good. I think that would work well from an investor perspective. So they want to see that you've got a good margin. I think they also want to see that your net margin is good when you do reach profitability, that the net margin can be good, and that there are good profits that can be generated from the business. I don't think they get into the too many ratios on the balance sheet side in terms of current ratios and things like that. They will look at the balance sheet for sure to see whether you have a clean balance sheet. Some of the things that they will look at, for example, would be, is there debt on the balance sheet? Are there a lot of directors' loans on the balance sheet? And they're not necessarily a problem, but for example, the due diligence process, which I know is the topic of the next webinar, will address those issues. So if there is debt on the balance sheet, they will want to look at the terms and what that debt relates to. If it's a function of helping the business to develop and expand, probably not an issue. If it's directors' loans, they will probably want to maybe either convert that to equity, or what they might agree is that you subordinate it and convert it into a long-term loan. So, that would be the normal practice there, I think.
What would you say is a reasonable period of time to meet the break-even point in order for your startup to be attractive to an investor?
Yeah, I think it differs from one business to the next. I think somebody may correct me on this, but I think Amazon wasn't profitable for the first 5 or 6 years because what they were doing was they were continuously investing, and they were scaling up to meet a huge market demand, which they've obviously captured in the interim. So I think it depends on the business, it depends on the sector, and we work quite a bit with medtech startups, and often the time to break even, it could be 5+ years in that particular instance. With a software business, it might be a case of maybe 24 months to 36 months. So it varies depending on the sector and the business and what the development phase is, and how long it takes to get the product to the market, and how long it takes to develop the customer base. But I would say medtech is longer, software is much shorter.
Okay, your focus is on a business to customer model. My business has a core emphasis on business to business model, not on revenue, but technology out licensing. Can you comment on how doing an out licensing model for technology transfer, how it differs from sales revenue models?
Yeah, that's very specific. So the example we had was more, it was a B2B model. It was essentially a company selling a product to another business. And I would say probably 80 to 90% of the work we do is on the B2B front. Business to consumer is a much more difficult nut to crack. It requires a lot of investment, it requires a lot of patience, a lot of market development costs, and you need investors and funders that understand that business. So it's difficult. In terms of technology transfer, licensing, yeah, that's again a different model, and what you need in that instance is you need a number of key partners that are going to license your technology, and usually I think the business model there, it requires specific advice from people that have experience in that sector in terms of how do you structure the licensing, the royalties, etc. I suppose it's simple enough to model, but I think the advice is very particular to that industry, and you need, I would think, to talk to somebody that has experience in doing that.
Okay. What if the intention is to be acquired before the business even gets to break even or profit?
Yeah, perfect. A lot of the medtech startups we work with are in that space. Their timelines are very long. For them to get their product to the market, it requires a lot of capex. So you might the capital expenditure to get the product to the market, requires setting up a manufacturing plant, clean room facilities, etc. Probably millions in expenditure. And often what happens is that they get to this, the objective of the company and the investors would be to develop the product, complete the R&D phase, validate the product in the marketplace, maybe outsource production and generate some early stage revenues from key clients. In other words, prove the concept in the marketplace, prove the demand, prove that the product works, and then exit before you actually ever get to scaling the business from a manufacturing perspective. So yeah, it's a common approach, and it's one that investors like because they can see a clear exit for the business. And that's something that's really important to think about is how do your investors and maybe the company itself even, how do your investors in particular exit from the business? How might that happen? Is it going to be a trade sale? And who typically are the likely organizations or companies that will acquire the business? And what examples are out there in the marketplace that show that similar companies have been acquired by whatever company, and what are the acquisition price paid, which is something again that investors will pay particular interest to.
Will the financial model help in putting a valuation on the business? And how do you use it for your entry valuation negotiation?
Yeah, I think, and I said this already, and this is a phrase that one of my colleagues uses who works on a day-to-day basis with the business angel sector and works with a number of syndicates, is that the valuation process we find is a bit of a black art, because it's usually, I think, investors are assessing opportunity versus risk. So if I go in at a particular point in the business, so it's an early stage, maybe the company's pre-revenues, okay, it looks good on paper, and you can, paper never refuses ink, so it looks good on paper, but how is that validated in the marketplace? And the due diligence process, again, which is part of the next topic, will assess that. So your model will help you to show that you have a business that can be profitable, hopefully, that it can generate a lot of cash, and it will give investors an indication of the potential. And they will then, I think, evaluate that potential against where the company is at present versus the market potential overall versus their own risk assessment and their appetite for risk. We usually find that at the early seed stage, that investors, particularly on the business angel side, if the valuation is more than 2 million, they will probably pause for thought, because they're thinking that, when it comes to an exit, if there's another round, my shareholding is diluted as part of that round, et cetera, that the return mightn't be there for me. So if the valuation is too high, we find it certainly turns off investors at an early stage. But again, you'd have to say it differs from one sector to the next as well.
Thank you,
John. The model helps, but it's not the be all and end all.
What do investors typically focus on when startups are telling their financial story?
Okay, so they want to see that this business can scale. They want to see the market potential. They want to see that the business can scale. They want to see that, over a 3 to 5 year period, that the business can generate significant profits, and they want to see that there's potential for them to exit out of that business in maybe 5 or 7 years, maybe at the max. And so that's all in the context of the numbers. But what they also want to look at then is the team and the people. And they want to see that I think the team has the skills and the capability and the experience to make this happen, because there are lots of business ideas that look really good, but what's key is the team that's behind it and their ability to drive the business and make it happen. And I think investors pay a huge amount of attention to the team's capability and their assessment of whether the team can actually make the business achieve the objectives and the numbers that are set out in the financial model. So I think team is really important, as well as the product plus the market potential. And one other thing they will focus on is what's the problem that you're solving and why is it a must-have product? And then the due diligence is equally important in terms of, the potential customers validating what you're saying as well.
When you do a 5 minutes pitch in front of investors, online or on-site, it's important to come with a slide with all your financials, or?
Yeah, I would make it simple. I would make it clear, and I would talk around the slide rather than referring to specific details. You might refer in a general sense, like I think in our slide, the P&L showed a minus 500K going up to maybe 3-4 million of profits by year 5. They want the high level bottom line figures. We expect to lose money in the first 3 years, but achieve break even maybe in year 4, generating substantial profits in year 5. We need 600K of investment. We're going to grow the team from 1 to 15 over a 3 to 5 year period. So I think you need to be able to rattle off the key financial figures off the top of your head. They're there in the background, maybe in your slide as you're doing your presentation, but I don't think you want to dwell too much on the detail. They will typically look for maybe a copy of the slide deck, and they can scrutinize that themselves afterwards. But I think you're giving them the high level figures. And I think that's important because they need to understand. I think what's important here is that you're communicating with your audience, your investors, and you're showing that you know the figures, you understand how this works, you understand the inputs in terms of the costs and the HR requirements, etc., and you know what that generates over a 3 to 5 year period.
You were mentioning a spreadsheet that you would make available to the audience that
Yes.
you're using yourself with your clients. Can you say a few words about this?
Yeah. So we're happy to make our the latest version of our model available. We constantly updating the model to try and make it easier for startups to use, and to try and make it as flexible as possible. And our model probably has about 10 sheets in it, but what we're asking startups to do is basically input the information into 3-4 sheets, which would be your sales and direct costs sheet, your staff sheet, your overhead sheet, and then if there's any capex, you drop the figures into those 4 sheets. And then it's formula driven, so it calculates your P&L, cash flows, balance sheets, monthly, quarterly, annually, and that allows you to understand the impact of the various variables as you drop them into the model and how it impacts on your bottom line in terms of your profit and loss. But also it allows you to look at your cash flows monthly, because that's absolutely crucial. As I said earlier, you're not going to go out of business in the short run because you're not profitable, but you are going to go out of business if you don't have enough cash, and cash is king for startups as it is for many businesses. So yeah, we're happy to make the model available. It's hopefully it will work for everybody on the call. We often find that we need to customize the model, so this is a generic kind of version. Hopefully it works for people, and feel free to use it.
Okay, so thank you so much. So we will, to the audience, we will send the spreadsheet after this event. This session will be available for replay on our platform from tomorrow on. I want to thank you, John, for this great
Thanks,
presentation. I hope you all enjoyed it. The next session is on the 18th of June. We will talk about due diligence. So you can already register, as I said before. You can also register to the session about pitching, the beginning of July. We also have a great speaker. Please give us a bit of feedback in a second. You will have a few questions popping up. And I wish you all a very nice afternoon. And I hope to see you next time. Bye.
Bye-bye. Thanks, Barry.
Bye, John. Ciao.